What's up, my trading family? Happy Thanksgiving week to you guys. So there's a big time misconception amongst new options traders that certain stocks, because of their price and the price of the options contracts, are off limits. Amazon is a great example of this, right? A lot of new options traders with a few $1,000s in their account, they completely ignore something like Amazon because the damn contracts cost $15 to $3,000 to $5,000 per contract. So obviously with a smaller account, it's a little bit tough for us, right? Now, here's the thing. A big name like Amazon, guys, a big market-leading name, oftentimes it's going to make some massive moves that you as an options trader don't want to be sidelined for. Now, right, if we take a look at the chain, right, and let's look at the 30-day expiration options. Granted, guys, these things cost a fortune. For a put, you're looking anywhere from $3,400 to $5,000, right? On the call side, you're talking the same thing, $4,000 to $5,000 just for one contract. If you've got a small account and you're new to the options game, that's a no-go, right? But like I said, it's a big market-leading name. Institutions really pile into Amazon, throughout the year. You want to be able to catch that move. So while buying a call or a put may be off limits based on, the size of your account, what you can do is take advantage of an options trading strategy known as a credit spread, where you're selling options rather than buying them. And this allows you, with a small account, to get involved in any Amazon trend, not for $4,000, not for $5,000, but in this example, I'm going to show you guys how you can get into an Amazon trade for only just under $400. Right, so a credit spread, guys, in this example, we're going to talk about a put spread, is an options trading strategy where you're simply taking advantage of the fact that out-the-money options are worthless come expiration. So as expiration approaches, out-the-money calls, out-the-money puts rapidly lose value. So in the example of this put credit spread, we are going to short the January 3rd 1700 put, and as protection, we would buy the 1695 put. Now, the put that we're shorting is worth about $1,400 a contract. The put that we're buying as protection is about $1,300 per contract. But if you could do one contract per side, you short one contract of the 1700 put, you buy one contract of the 1695 put. If you take a look down here, guys, your broker is only going to require you just under $400 to get into this trade. So you're risking $375 with a potential max profit of $125. That's a great risk reward, right? It's a really solid return on capital in a massively expensive stock. So if we can get in Amazon and catch these potential trends that it makes for less than $400, all of a sudden, the stock that was once off limits to you now becomes a name that you can trade. So I'm not going to go into an entire lesson, guys, about credit spreads, about put spreads and how they work. You can go look at a few of my recent videos to get, some really good info on that. But nonetheless, right, we take a look here at this spreadsheet, and this will give you guys an idea of how a put spread works. So a put spread is a two-sided trade. You're shorting a contract and you're buying an even further out-the-money contract as protection. So in the example of this put spread, guys, which again is going to cost you less than $400 to get in there with the potential to make a little over $100, we're going to short one contract of the 1700 strike put at $14.20. We are going to buy to protect ourselves. Never sell an option naked. Fucking never. We're going to buy one contract of the 1695 put at $12.90. Now think about this. This is the whole, foundation of a credit spread. As expiration approaches, and as we hit expiration, any option, any call, any put that is out the money. So on the put side, any put with a strike below the current price of the stock, come close on expiration date, is going to be worthless. So if we were to take this trade yesterday, we're shorting that 1700 put when it's worth $14.20 per contract. We're buying that 1695 bad boy when it's worth $12.90. Now if we take a look at the Amazon chart, you're going to hit your max profit on this trade as long as Amazon closes anywhere above 1700 come expiration. And here's how you would end up making that max profit. Again, this is all about premium decay. It's just the essence of how options work. So come expiration, we fast forward, 4 or 5 weeks from now, as long as Amazon is anywhere above 1700, it could be 1710, it could be 2100. Just stay above 1700, baby. We stay above 1700, here's what's going to happen on the day of expiration. The 1700 puts that you shorted at $14.20 are going to be worth $0. So you collect $1,420 of profit, aka credit. Now that 1695 put we bought as protection at $12.90 that would be out the money in this example. That's also going to zero. So our protection piece is going to lose us about $1,290. The difference between the two here, guys, is your $130 profit. So credit spreads, put spreads, and call spreads, they allow us to trade these options that have very expensive contracts in the $3,000 to $5,000 to $8,000 per contract range with a few $100s. So here's an example, guys. With less than $400, you can get in a crazy expensive stock like Amazon and take advantage of the moves that it can make without having to pony up for those crazy expensive options. Now, the other benefit of selling puts rather than buying an expensive call is that you don't have to be quote-unquote right, meaning that if you put on that put spread yesterday, you're under the assumption that Amazon is going to move higher. But remember, we're making our max profit. We're making $100+ as long as Amazon closes above 1,700, because then both of those puts in our put spread are going to nada, baby. So realistically, guys, obviously, we're looking for Amazon to move higher here. But the truth is that we just need this thing to close anywhere above 1,700 come expiration, and that little paycheck is ours. So we could be dead wrong, right? Amazon could barely move higher for the next 4 weeks. We still make our max profit at expiration. Amazon could just go sideways, right, in a painful consolidation for the next 4 or 5 weeks, and guess what? Your puts are going to expire worthless because they're out the money. You're still making your paycheck. And here's where this gets pretty sick, right? Amazon could literally come against you. You think it's going to move higher. It could, in fact, move lower. But as long as it's above 1,700 by expiration, that paycheck is yours. So for you new options traders out there, I really suggest going through some of my recent videos and learning more about credit spreads. They're very high probability ways to take advantage of these potential trends in any stock, regardless of the price of that stock, regardless of the price of those options contracts, and best part, regardless of your account size. So if you enjoyed this video, guys, hit subscribe down below. And if you're not in the Focus Trades family already, I hope to see you in there soon. I'll catch you guys in the next one. Happy Thanksgiving.